and welcome back to With Sikhya. In the last two videos, we discussed how to earn additional money through investing. In this video, let's talk about how to select the apt mutual fund. Now, there are so many mutual fund schemes in the market that selecting the one that suits your need can be very confusing. So let's figure out a way to select a mutual fund that suits your requirement the best. Choosing a mutual fund in the Indian financial market involves several steps and considerations. Here's a comprehensive guide to help you make an informed decision. Number 1. Determine your investment goals. Short-term versus long-term. Define your investment horizon. Risk tolerance. Assess your risk appetite. Financial goals. Understand whether you are investing for retirement, education, wealth creation, etc. Number 2. Types of mutual funds. Equity funds. Invest in stocks suitable for long-term growth but comes with higher risk. Debt funds. Invest in fixed income securities suitable for stability and regular income. Hybrid funds. A mix of equity and debt, offering balanced risk and return. Index funds. Track a specific index like Nifty or Sensex, offering passive management. Sector or thematic funds. Invest in specific sectors carrying higher risk due to concentration. ELSS or Equity Linked Savings Scheme. Tax saving funds with a lock-in period of 3 years. Number 3. Evaluate fund performance. Historical returns. Look at past performance over different periods. 1 year, 3 years, 5 years. Consistency. Check for consistency in returns compared to peers and benchmarks. Risk. Adjusted returns. Consider ratios like Sharpe ratio, Sortine ratio, etc. Number 4. An expense ratio is a measure of the cost associated with managing and operating as an investment fund, such as a mutual fund, index fund, or exchange traded funds or ETF. It is expressed as a percentage of the fund's assets and is deducted from the fund's returns. The expense ratio includes various costs such as number 1, management fees, fees paid to the fund manager or investment advisor for managing the fund's portfolio. Number 2 is the administrative fees, costs related to the day-to-day operations of the fund, such as record keeping, custodial services and accounting. Number 3. Marketing and distribution fees, sometimes referred to as 12B1 fees. These cover the marketing and selling of the fund. Number 4. Other operating expenses, miscellaneous costs like legal and auditing fees. For example, if a fund has an expense ratio of 1%, it means that 1% of the fund's assets are used to cover these expenses annually. This cost is automatically deducted from the fund's returns, meaning investors don't pay it out of pocket, but see it reflected in their overall returns. A lower expense ratio is generally preferable as it leaves more of the fund's returns in the investor's hands. However, it's important to consider other factors such as the fund's performance when evaluating the overall value of an investment. Number 5. Fund manager's track record. Assess the fund manager's experience, past performance, and investment strategy. Number 6. Fund house reputation. Choose funds from reputed and well-established fund houses. Number 7. Diversification. Ensure the fund offers adequate diversification to mitigate risk. Number 8. SIP or lump sum. Decide whether to invest through a systematic investment plan or SIP or a lump sum based on market conditions and your financial situation. Number 9. Exit load and other charges. An exit load, also known as exit fee or redemption fee, is a charge levied by a mutual fund or other investment fund when an investor sells or redeems their units in the fund before a specified period. The purpose of an exit load is to discourage short-term or frequent trading, which can disrupt the fund's management and impact other investors. The exit load is deducted from the redemption proceeds, meaning investors receive less than they would have without the fee. This mechanism helps fund managers maintain a stable investment pool, reduces the impact of sudden large withdrawals on the remaining investors. Be aware of any exit loads and additional charges that might apply. Number 10. Tax implications. Understand the tax implications of your investments, especially for equity and debt funds. Steps to select a mutual fund. Number 1. Research. Utilize online platforms like Morningstar, Money Control, Value Research, etc. for detailed fund analysis. Number 2. Shortlist funds. Based on the above criteria, shortlist 3 to 5 funds that match your investment goals. Number 3. Compare. Compare shortlisted funds on performance, risk, expense ratio, and other factors. Number 4. Consult an advisor. If needed, consult a financial advisor for personalized advice. Number 5. Invest. Once satisfied, proceed with your investment through a broker, online platform, or directly with the fund house. By following these steps and regularly reviewing your investment, you can make informed decisions and maximize your returns in the Indian mutual fund market. Let's understand the process using an example. Let's say you are a 30-year-old investor with a high risk tolerance and a long-term investment horizon. Let's say about 10 years. Your goal is wealth creation. Number 1, define investment goals. Long-term wealth creation for future financial security. Number 2, assess risk tolerance. High risk tolerance, so equity funds are suitable. Number 3, investment horizon. 10 years, which is a long-term horizon. Number 4, evaluate fund performance. Choose a few top performing equity funds. For example, look at Axis Blue Chip Fund, Mirae Asset Large Cap Fund, and HDFC Equity Fund. Check their 1 year, 3 years, and 5 years returns and compare them with the benchmark index, example Nifty 50. Number 5, check expense ratio. Compare the expense ratios of these funds. Lower ratios are preferable. For instance, if Axis Blue Chip Fund has an expense ratio of 1.7%, Mirae Asset Large Cap Fund is 1.6%, and HDFC Equity Fund is 2%. Mirae Asset might be more cost effective. Number 6, fund managers' track record. Research the fund managers. If Mirae Asset Fund Manager has a consistent and strong track record, it could be a positive sign. Number 7, funds portfolio. Look at the top holdings and sector allocations. Ensure they align with your investment philosophy. If Mirae Large Cap Fund has a good mix of diversified sectors, it might provide balanced growth. Number 8, fund size. Check if the fund size is reasonable. Very large funds may face challenges in delivering high returns, while very small funds might be more volatile. Number 9. Additional costs. Look for any exit loads. Suppose Mirae Asset's large cap fund has a 1% exit load if redeemed within 1 year, which is standard. Number 10. Offer document. Read the fund's prospectus for complete details on its investment strategy, risks, and costs. Based on the evaluation, if Mirae Asset Large Cap Fund shows consistent performance, has a lower expense ratio, and aligns with your risk profile and goals, you might decide to invest in it. Remember, it's crucial to periodically review your investments and make adjustments as needed based on changing financial goals and market conditions. This brings us to the end of the video. I hope you found it informative, and if you did, do give it a thumbs up and share it with your family and friends. And I hope by now you have subscribed to our channel with Sikhya. If you haven't, please do so. Thank you for watching. See you in the next video. Till then, have a happy and safe investment.